Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at Vishay Intertechnology.
If you find our talks useful, please consider subscribe, like, and comment underneath.
And before we get into today's stock, here is a useful tool for investors who want a faster and cleaner research workflow. You can check out stockanalysis.com Pro through the link below in the description. Use discount code ITP for 10% off. Stockanalysis.com is lightweight, fast, and works on desktop, iOS, and Android. The free version is useful for checking stock prices, financials, charts, forecasts, and news. But if you want deeper research, stockanalysis.com Pro gives you no ads, saves screeners, watch lists, portfolios, long-term financial history, dividend history, analyst filters, ETF data, and exports to Excel, CSV, and Google Sheets. Pro comes down to about $5.93 per month when billed annually after the discount. For heavier users, the unlimited plan adds unlimited downloads and unlimited stocks per watch list, and comes down to about $14.93 per month when billed annually after the discount. Stockanalysis.com is a research tool, not financial advice. It does not tell you what to buy or sell, and it does not guarantee investment results. Always do your own research and make your own investment decisions.
This is an affiliate link, so we may earn a commission if you use it at no extra cost to you.
Imagine waking up and finding out that the boring, invisible company that makes those tiny, unglamorous volume knobs for old stereos is suddenly one of the hottest stocks in the global energy revolution. Today, our mission is to figure out if this massive 200% breakout we are seeing in Vishay Intertechnology is the start of a permanent industrial paradigm shift, or just, a temporary bubble waiting to pop.
Yeah, it is a truly wild transition to witness. For decades, the market looked at this company and just saw a sleepy supplier of passive electronic components.
Right, the kind of stock that just drifts along in the background of a broad index fund.
Exactly. But recently, it has completely defied its historical trading norms. We're looking at a structural breakout that is literally forcing institutional investors to, completely rewrite their models.
But anytime a legacy hardware company goes parabolic like this, you really have to look under the hood. And right now, there is a massive valuation anomaly staring us right in the face.
You mean the PE ratio, right?
Yeah, the PE ratio. Because if you pull up the basic metrics for this company on any terminal today, you will see a trailing price-to-earnings ratio of nearly 5,000.
Which is just terrifying on the surface.
Right. Not 50, not 500, 5,000. At first glance, it legitimately looks like a data typo. It's the kind of number that immediately sets off alarm bells for anyone who, remembers the dot-com crash.
All right, let's move into the wealth building context.
Because to figure out if that massive premium is actually justified, you have to understand how a component manufacturer fits into a multi-year portfolio strategy.
Yeah, we are not talking about a quick software flip here. This is fundamentally a physical infrastructure play. The core thesis revolves around what management calls their Vishay 3.0 strategy.
Vishay 3.0.
Right, because the entire world is currently undergoing this massive simultaneous build-out across three fronts. You have artificial intelligence data centers, electric vehicles, and broad grid electrification.
All happening at exactly the same time.
Exactly. And the technical reality uniting all three of those megatrends is that they require a staggering increase in what engineers call the bill of materials content per watt.
Okay, let's unpack that because it's the core of the whole argument. The market loves to obsess over the glamorous stuff, right? The companies designing the ultra-fast AI chips or building the really sleek electric cars.
Oh, sure, the flashy headlines.
Yeah, but if you put one of those advanced AI processors into a server rack and just plug it straight into the wall, it will instantly melt. The power has to be stepped down, conditioned, and managed perfectly.
Right, and that is where Vishay comes in. If the AI chips are the high-speed engines of the modern tech world, Vishay makes the heavy-duty brake pads, the transmission valves, and the cooling regulator.
The picks and shovels.
Exactly, the picks and shovels during a gold rush. You need a massive volume of microscopic components. Things like MOSFETs stacked as digital switches, diodes to keep electricity flowing in only one direction, and inductors to store and relieve energy smoothly.
The end systems just simply cannot function without these passive electronics. The more power an AI data center or an EV draws, the more they rely on those basic components to keep from literally bursting into flame.
And it scales exponentially.
It does, but hold on a second. We have seen this hardware supercycle movie before, haven't we? What usually happens is a new technology emerges, everyone panics and overorders parts, the component makers build too many factories, and then, 2 years later, supply catches up and the stock
A
crashes.
classic boom and bust cycle.
Exactly. So I have to ask, is this really a permanent structural shift in our global power needs? Or is this just the market pulling forward 5 years of demand into a temporary cyclical bubble?
Well, the structural shift argument actually has real teeth here,
Hmm.
because we aren't just dealing with a temporary shortage of legacy parts. We are looking at next-generation engineering specifications.
What do you mean by that?
When an automotive company redesigns the powertrain for a new electric vehicle or an industrial giant upgrades a power grid, they are locking in design wins that last for 5 to 10 years. They can't just easily swap these parts out later. This isn't a cyclical peak. It is a completely new, permanently elevated baseline for global power consumption.
Now let's look at the fundamentals.
Because if they are truly building the physical backbone of this electrification boom, the math really needs to support the narrative. And the numbers coming out of the first quarter of 2026 are exactly what sparked this fundamental reassessment.
Right, so let's get into the numbers. Revenue hit $839.2 million, which represents a 17.3% year-over-year increase.
Yeah, they beat the consensus estimates and their own prior guidance with that.
They did, and they also swung back to profitability. GAAP earnings per share came in at a 5-cent profit. That beats the 3-cent consensus and marks a pretty sharp reversal from the 3-cent loss they posted in the prior year period.
But the revenue is almost a trailing indicator here. The metric you really need to pay attention to is their book-to-bill ratio.
The book-to-bill, that is a massive one for this industry.
It is the ultimate health check for a manufacturing business. For those who don't know, it measures the number of new orders coming in versus the number of orders they are actually shipping and billing out.
So a ratio of 1.0 means demand perfectly matches supply.
Right. And the overall company ratio is currently sitting at 1.34. But the semiconductor segment specifically, it has an incredibly robust book-to-bill of 1.47.
Which is incredibly high. Think about what that actually means on the factory floor. For every 100 components they finish manufacturing and ship out the door, they are receiving 147 brand new orders.
Yeah, their future revenue backlog is stacking up significantly faster than their physical capacity can handle right now.
And because demand is outstripping supply like that, their pricing power naturally improves, which flows straight through to the margins. Gross margin expanded to 21.0%, up from 19.6% in the previous quarter.
Furthermore, management is guiding second quarter margins even higher, up to 22.0% on projected revenues of $875 to $905 million.
And from a balance sheet perspective, the liquidity is very safe. They maintain a current ratio of 2.64 and a quick ratio of 1.53.
That basically means they have more than enough cash and easily liquidated assets to cover their short-term obligations over the next year.
Exactly. And because their debt-to-equity ratio is low, sitting at a highly manageable 0.47, they actually have the financial war chest needed to expand.
Which brings us to the most controversial part of their financials, the free cash flow.
Yeah, you cannot ignore the cash burn here. The company is currently dealing with deep negative free cash flow because they are spending a record $400 to $440 million in capital expenditures.
It is a massive outlay.
It really is. I mean, for a legacy industrial supplier, pouring $500 million into concrete, new machinery, and retooling is a huge risk. Are they spending way too aggressively right at the top of a cycle?
See, that capital expenditure is the entire point of the Vishay 3.0 strategy. Because their debt is so low, they can actually afford to build these new factories without taking on punishing high-interest loans.
I guess that's true, but still.
Think about it. If you have a book-to-bill ratio of 1.47, you are literally leaving money on the table if you don't build the capacity to fulfill those orders. Management has explicitly stated that these aggressive investments are nearing completion.
So the heavy lifting is almost done.
Exactly. And once those new production lines flip the switch, that massive backlog translates directly into free cash flow.
That brings us to the catalyst timeline.
For anyone watching this space, the next 3 to 6 months are really the make-or-break window. The most immediate catalyst is the Q2 2026 earnings report coming up in late July or August. The market has essentially designated this as the validation zone.
Because the stock has priced in a massive amount of optimism based on these future factory outputs. Now, they actually have to prove they can hit that 22% margin target and deliver the $875 to $905 million in revenue.
Right. If they miss that guide, or if supply chain snags delay their shipments, the market's narrative is going to turn negative extremely quickly.
Beyond just earnings, you also have to look at where they are physically showing up in the industry. Right now, they are at PCIM Europe 2026.
Oh yeah, that is one of the most critical power electronics exhibitions in the world.
Exactly. And they are there showcasing brand new automotive-grade optocouplers directly to the buyers who control the EV and renewable supply chains.
For some context on why that matters, think of an optocoupler as a microscopic bridge that uses a beam of light to send an electrical signal safely between two isolated circuits.
Which is incredibly critical in an electric vehicle.
Right, because it ensures a massive high-voltage power surge from the main battery doesn't accidentally cross over and fry the delicate low-voltage computer that's, processing the car's steering or brakes. Securing contracts for those specific parts locks in revenue for the entire life cycle of a vehicle platform.
We are also seeing a broadening macro upcycle across the entire analog semiconductor sector. When you look at massive bellwether peers like ON Semiconductor and Texas Instruments, they're actually reporting that their long-standing inventory gluts are finally stabilizing and new bookings are improving.
And Texas Instruments is basically a barometer for the broader hardware space. If they're turning a corner, it provides a massive sector-wide tailwind that confirms Vishay's demand isn't just an isolated fluke.
But wait, let's talk about the AI narrative for a second here, because the CEO recently noted that their exposure to AI data center demand is moving well above $100 million.
That's a huge growth avenue.
But isn't AI just Wall Street's favorite magic word right now? I mean, every legacy company on the market is trying to slap an AI label on their quarterly report just to inflate their stock price. Are these design win conversions in the data center space actually real, quantifiable contracts, or just theoretical upside being used to justify this massive run-up?
It is smart to be skeptical of the AI buzzword, definitely. But in this case, the actual physical mechanics demand it. You simply cannot build a modern AI server rack without physical cooling and hyper-precise power regulation.
Just too much heat.
Way too much heat. The sheer power density required to run massive language models means you need industrial-grade resistors and inductors that can handle extreme heat and extreme electrical loads. That $100 million figure is a tangible, quantifiable starting point for physical components actually being shipped, not just some theoretical concept.
Now let's pivot to the chart.
Because the technical setup we are seeing is genuinely historic. We mentioned the uninterrupted 203% rally, but looking year-to-date, the stock is up a staggering 240.42%.
Which is just hitting new one-year highs over and over.
Right. It is radically outpacing any historical rally we've ever seen from this company. Usually, component makers are highly cyclical and choppy. Previous peaks for the stock typically capped out around 30 to 80% before sharply correcting.
And the moving averages confirm a very strong bullish alignment here. The 50-day simple moving average is currently sitting at $26.40, and it's pointing sharply upward.
That is miles above the longer-term 200-day moving average.
Miles above. The 200-day is lagging all the way down at $20 flat. Right now, the price action is carving out a very tight bullish continuation pattern, consolidating sideways in a tight range between roughly $47 and $50.50.
And honestly, that specific sideways consolidation is the healthiest thing you can see after a 240% run.
But you really have to ask, is this entire chart just a house of cards built on retail FOMO?
You think it's just day traders?
Well, when a traditionally boring stock suddenly rockets upward that fast, it usually means amateur traders are chasing the momentum. They create this fragile bubble that pops the exact second the buying volume dries up.
It's a fair worry, but the internal market data actually completely shuts down the retail FOMO theory here. The order flow metrics point to highly organized institutional accumulation.
Organized accumulation.
Yeah. There is a metric called the predictive blue line, which tracks the footprint of anticipated algorithmic trading trends, and it is consistently holding as a level of support. But more importantly, whenever there is a minor intraday pullback, the supply is immediately and aggressively bought up.
Which tells you exactly who is doing the buying. Retail traders tend to panic sell during red days. Massive institutional funds, however, use those dips to quietly build larger positions without spiking the price further.
Exactly.
The fact that the stock is holding so tightly in that $7 to $50 range implies that big funds are happily absorbing any available shares, essentially locking up the float before they anticipate the next leg higher.
So what does market sentiment look like?
Well, we are seeing major shifts in how Wall Street fundamentally perceives this business model. The quantitative sentiment scores are heavily flashing bullish.
Yeah, Wall Street Zen and Zacks Research both recently upgraded the stock to buy and strong buy, respectively. Argus also stepped in and initiated coverage with a strong buy rating.
And JP Morgan even had to rip up their old models, lifting their price target from $14 all the way up to $20.
Furthermore, on June 3, 2026, market scanners picked up significant whale activity across the broader IT sector options chain.
Oh, the whale activity, yeah.
When you combine massive outsized options block trades with the institutional price action holding that tight consolidation range, it strongly confirms that the smart money is quietly positioning itself for a much larger move.
The broader analog upcycle is also feeding a lot of speculative upside in the rumor mill right now. There are serious whispers that larger semiconductor peers might want to acquire Vishay outright.
An M&A play.
Exactly. The strategic logic is that a bigger player could simply swallow them whole to instantly round out their own power electronics offerings, rather than, spending years trying to build out competing automotive and industrial supply chains from scratch.
But we cannot ignore the elephant in the room here.
Bank of America.
Bank of America. Despite all these upgrades, the M&A rumors and the technical breakout, Bank of America Securities is maintaining a firm underperform rating on the stock.
Yeah, the sheer momentum of the market forced them to raise their price target from $18 to $28, but fundamentally they remain bearish.
And that is a massive institutional voice telling you to proceed with caution.
It is an important counterweight, but you have to understand why major banks sometimes lag on these ratings. Raising a target by a full $10 while stubbornly maintaining an underperform rating usually indicates that their quantitative models are breaking under the pressure of the stock's actual performance.
Whoa, because their backward-looking algorithms are likely penalizing that massive capital expenditure burn without fully crediting the forward-looking backlog conversion.
Exactly.
Now let's talk about the risks.
Because despite the incredibly bullish technical setup, the bear case here is substantial, and it all starts with that terrifying surface-level valuation. If you run a traditional discounted cash flow model, which attempts to value a company based purely on the present value of its projected future cash flows, the estimated fair value for this business sits around $17.50.
And the stock recently closed at $52.05.
Right. So by the strictest mathematical interpretation of current cash flows, the stock looks almost 200% overvalued.
And then there is that trailing price-to-earnings ratio we mentioned right at the beginning of our discussion.
The astronomical 4,979.
Exactly. When a company's price detaches that violently from its intrinsic present-day cash generation, the downside risk becomes incredibly severe. The market has priced this for absolute perfection. If they disappoint investors by even a fraction of a percent in their next earnings call, the stock is highly vulnerable to a sharp, punishing pullback just to close that valuation gap.
There is also a massive execution risk regarding their highly touted backlog. Yes, they have 5.7 months of orders stacked up. That sounds fantastic on a glossy investor presentation. But if they fail to physically convert those orders into shippable revenue, they fall into what analysts call a good orders, bad earnings trap.
Right, because you can have all the demand in the world, but if you hit working capital pressures or if a minor supply chain hiccup prevents you from getting the raw materials to finish those components, your factories just sit idle. The orders just sit on a spreadsheet while the bottom line bleeds cash.
But we really need to unpack the math behind that 5,000 PE ratio, because just looking at the headline number doesn't tell the whole story.
It really is a mathematical distortion. The PE ratio is the stock price divided by the earnings. If a company goes into a massive reinvestment phase like spending hundreds of millions on new factories, their net earnings temporarily drop to near zero.
Ah, so you are dividing a $50 stock price by just a penny of earnings.
Exactly, which artificially spikes the ratio to 5,000. It doesn't mean the company is fundamentally broken. It means they are at the absolute trough of an investment cycle.
That is exactly why forward-looking metrics are much more useful right now. If you look at the forward price-to-sales ratio, which measures the stock price against the revenue they are projected to generate once these factories are online, it is actually only 2.2 times.
And the average for the broader U.S. electronic industry is 3.2 times.
Right. So if that operating leverage kicks in, they are actually trading at a significant discount relative to the revenue they will be capturing.
So with everything on the table, what's the final verdict?
Well, when you synthesize the complete fundamental turnaround with a historic technical breakout, the research yields a bullish score of 7 out of 10.
The core thesis here is that this company has permanently transitioned from a cyclical rebound trade into a critical infrastructure pillar for global power conversion. They have a $1.6 billion backlog waiting to be fulfilled.
And if the second quarter earnings prove they can efficiently execute on that backlog at a 22% profit margin, the stock will likely experience a permanent structural re-rating by the broader market.
And that really dictates how you should frame your timeline. For investors researching this space, the setup suggests a medium-term 6 to 12-month investment horizon.
Yeah, that is the exact window required to capture this margin expansion cycle and validate whether that massive backlog actually converts into profitable growth. You are essentially giving the fundamental financial story the time it needs to catch up to the technical breakout.
It leaves you with an interesting thought to explore on your own. As we rush to build out AI and electric vehicles, the ultimate bottleneck won't actually be the software or the chips.
It will be the physical limitations of the power grid itself. If you want to build a cleaner stock research workflow, you can check out stockanalysis.com Pro through the link below in the description. Use code ITP for 10% off. Pro comes down to about $5.93 per month when billed annually after the discount, and Unlimited comes down to about $14.93 per month when billed annually after the discount. Remember, stockanalysis.com is a research tool, not financial advice. It does not guarantee investment results, and you should always do your own research before making any investment decision. This is an affiliate link, and we may earn a commission at no extra cost to you.
And if this episode helped you, please subscribe, like, and comment underneath. We'll see you in the next Smart Wealth with Joshua episode. stockanalysis.com Pro Unlimited.
stockanalysis.com pro.resupp. Use code ITP for 10% off.
About $5.93 after discount when billed annually.
About $14.93 after discount when billed annually.
We may earn a commission if you sign up through our link.